Okay, you've dropped a stack of fascinating material in our lap, articles, research, notes, all diving into the world of angel investors.
It really is the stuff of startup legends, isn't it? I mean, these are the people stepping in right at the beginning.
Yeah, placing bets on ideas that are, well, often barely formed.
Exactly. Investing in the future, hoping to fund that next groundbreaking thing.
So, our mission in this deep dive is basically to strip away some of that mystique. We want to pull out the key insights from all this material.
Right. Understand what makes an angel investor tick, how the process works.
And maybe most importantly, figure out what you can take away from their approach, even if you're not planning on writing multi-thousand-dollar checks anytime soon.
It's all about getting to those core ideas, the logic behind funding things nobody else wants to touch yet.
Okay, so let's jump right in. Based on everything we've looked at, what's the fundamental definition? What is an angel investor?
Well, at its heart, the material defines them as early-stage investors. They provide that critical seed money.
Seed money, right?
Yeah, seed money for a startup, and typically they get ownership equity in return, so a slice of the company's potential future value.
And that seed money part is just so key, isn't it? It's the capital that helps them get going before they have the track record banks look for.
Exactly. It's not about collateral or credit scores at this stage. It's purely about the potential they see in the idea.
And it's crucial to understand, like you said, it's not a loan.
Absolutely not. There's zero obligation for the startup to pay it back if things go south. The angel only sees a return if the company becomes valuable, gets acquired, goes public.
If it fails, the money's just gone.
Poof, gone. Which is fascinating considering the name angel actually came from financing Broadway plays, apparently.
Well, really, I saw that mentioned. Wealthy folks funding shows that couldn't get traditional backing.
Yeah, acting as angels, hoping the play would be a hit so they'd get paid back.
Yeah.
Same principle, different stage.
And the profile, generally.
Typically, yeah, it's wealthy individuals using their own money. And the sources are clear. They're looking for much higher returns than, say, stocks or bonds, precisely because the risk is so immense.
Makes sense. And we see other names too, right? Informal investors, seed investors.
Business angels, private
Right.
investors. Yeah, they all point to that same role, providing that very first foundational chunk of cash.
Okay, so we know who they are. How does this actually play out in the real world? How do they find these startups? What happens?
They're actively hunting for startups with ideas that grab them, but this is where it gets really tough. These ventures are incredibly unproven.
Right. The risk factor must be astronomical.
It is. One source we looked at cited a survey estimating only around 11%, just 11% of these angel bank companies actually end with a positive return for the investor.
Wow. So nearly 90% and negatively. That failure rate is, well, it's kind of the defining characteristic, isn't it?
It absolutely shapes their whole strategy. It has to. They go in expecting most of their individual bets to fail or just break even. That forces a completely different mindset about building a portfolio compared to, buying index funds.
Totally. And it explains why, even though the potential jackpots are huge, the actual check sizes are often pretty modest relative to their total wealth.
Yeah, the data showed average investments around, $42,000 for experienced angels, and less for newer ones, maybe $25,000.
And that's typically a tiny fraction of their overall portfolio, like
Yeah.
15% for the experienced ones, maybe only 7% for the less experienced.
It's pure risk management. They can afford to lose that small percentage on most of the bets because they're banking on one or two hitting it big.
So how do they even connect? Finding the right startup or the startup finding the right angel seems like finding a needle in a haystack.
Well, the material laid out a few main ways. Angel groups or networks are pretty common, sort of organized clubs where they pool resources and deal flow. Then there are personal connections, friends, colleagues, people they already know and trust. That's still significant.
Sure.
And increasingly, you see online platforms, crowdfunding sites, kind of acting as matchmakers. And sometimes it's just a determined founder knocking on doors, digitally or literally.
And for the entrepreneur, why take this route instead of, say, trying for a small business loan?
Oh, the advantages are huge if you can get it. You get money when banks probably wouldn't touch you.
Yeah.
And the terms, well, there's no crushing debt repayment hanging over you if the business struggles initially. The focus is just on getting liftoff.
But it's definitely not a free ride, is it? What's the catch for the founder?
Right. The trade-off is significant. You're giving up equity, a piece of your company, your future profits.
Ownership.
Exactly. And the angel often wants a say. They might ask for a board seat, offering guidance, but also wanting some level of influence, maybe even control, depending on the deal.
Okay, so they provide capital, maybe some guidance. But how on earth do they pick the right ones? Especially when the ideas are so raw, so unproven. It can't just be about the financials at that stage.
It absolutely isn't. And this is where we get into what the sources call the visionary mindset. It's less about analyzing current numbers.
Because there often aren't any.
Exactly. It's more about seeing the potential, seeing what could be, where others just see what is, or maybe just see the problems.
That visionary lens idea, looking beyond the present.
Yes. And the research highlighted a few parts to this. First, anticipating the next wave. They're not just following trends. They're trying to spot or even shape what's coming next. Looking for unsolved problems, new technologies.
Like that iPhone example, right? When it first came out, lots of people saw a phone. Visionary investors saw the platform, the potential for a whole app economy, and they backed those early app developers.
Precisely. Which leads to the second bit, identifying disruptive innovation. They're not usually funding a slightly better version of something existing.
They want the game changer.
They want the game changer. The idea they could completely overturn a market. Think Netflix and Blockbuster or Uber and taxis. That kind of scale of disruption.
And they filter this through that why now question, didn't the sources say?
Crucial question. Yeah.
Yeah.
Why is this idea viable right now? What's changed? Is it new tech? A shift in consumer behavior, a new regulation? What makes this moment the right time for this specific thing to take off?
It sounds like it's about connecting a lot of dots.
Totally. It's not magic. It's about synthesizing information from all over, demographics, tech, economics, psychology. They read a ton, talk to experts, stay curious, trying to piece together a picture of a future opportunity.
Which is just a fundamentally different skill set than traditional financial analysis that looks backwards at historical data.
Yeah.
You're projecting forward with very little hard evidence.
And speaking of limited evidence, especially early on, the material really hammered home something else. The people factor.
Yes. This really jumped out at me, too. The idea that the team behind the startup is often seen as more important than the initial idea itself.
It's a classic angel investing principle. You hear that saying all the time. Bet on the jockey, not just the horse. Or better an A-plus team with a B idea than a B team with an A-plus idea.
Why is that?
Because the initial idea, it's almost certainly going to change. Pivot. Evolve. The market might not be what they thought. The tech might need rethinking. The angel is fundamentally betting on the founder's ability to navigate all that chaos, to adapt and execute.
So what are they looking for in that team? What are the key qualities?
The sources listed several things. Passion and drive are huge. Are they obsessed with this problem? Resilience, coachability, can they handle failure, take feedback?
Can they learn?
Exactly. Domain expertise, do they actually know the industry? Complementary skills, is it a well-rounded team, not just, say, 3 engineers? And fundamentally, integrity. Can you trust these people with your money and your time?
Because the product might morph, the market might shift, but a really strong, adaptable team can figure it out. A weak team, well, even with a brilliant concept, they'll likely stumble when things get tough.
Which is why that pitch meeting is so critical. The angels aren't just evaluating the business plan on paper. They're watching the founders. How do they present? How do they handle tough questions? Do they show conviction, clarity, competence? It's a real assessment of leadership potential.
Okay, so we've established the risk is massive, that 11% success rate looms large. How do angels actually manage this? It's got to be more than just crossing their fingers, right? It's not just reckless gambling.
Oh, far from it. It's managed through very calculated risk-taking and a specific kind of diversification. They accept that high failure rate up front. They know most individual bets won't pay off.
So the goal isn't to pick only winners, because that's impossible.
Right, it's impossible. The goal is to structure things so that the winners, when they hit, pay for all the losers and then some. A lot more, hopefully.
So they build a portfolio, making lots of smaller bets.
Exactly. Building a portfolio of startups. Sometimes it gets called spray and pray. But the good angels are still doing due diligence on each one. It's their version of diversification, but it's totally different from balancing stocks and bonds. They're hunting for the outlier, the massive success.
This is where that power law concept comes in, right? The idea that a tiny fraction of the investments generate almost all the returns.
Precisely. Maybe, 10 or 20% of their successful exits generate 80 or 90% of the total portfolio gains. They need those grand slams to make the whole model work.
But they still do some homework beforehand, even early on.
Oh yeah, absolutely. Due diligence is still key, even if it looks different than later stage investing. They're digging into the market potential, the technology's feasibility, the founders' backgrounds, the basic legal setup. They need to understand the nature of the risk they're taking with each specific company.
And maybe the hardest part, especially for people used to public markets, patience.
Immense patience is required. This is not a get-rich-quick scheme. The material consistently points to timelines of 5 to 10 years, sometimes even longer, before there's any kind of liquidity event like an acquisition or an IPO. No quick flips here.
It's a seriously long-term game, betting on value creation way down the road.
Definitely.
So who can actually be an angel investor? Do you need to be a tech billionaire?
Not necessarily. The sources were pretty clear. Basically, anyone with the capital and the appetite for this kind of risk can potentially be one, and entrepreneurs actively look for them because they fill that funding gap banks won't.
And it seems like a lot of them have been successful entrepreneurs themselves.
That's very common. They understand the roller coaster ride of a startup. Many seem to genuinely enjoy staying involved, mentoring, offering advice. It's not just about the money for them.
So it's usually their personal wealth being invested.
Right. But the sources mentioned the actual investment might come through an LLC or a trust or some kind of fund structure, for legal and tax reasons mostly.
But we have to stress that core risk again. If the startup tanks early, the angel loses everything they put in, period.
Absolutely. Which is why professional angels are always thinking about the exit strategy from day one. How will they eventually get their return? Acquisition, IPO.
The idea of an accredited investor also came up in the reading. What's that about? Is it a requirement?
So that's a specific SEC designation. It's based on financial thresholds, having a certain net worth, like over $1 million excluding your house, or a certain income level for a couple of years. Plus, showing you understand complex investments.
Okay, so it's a formal status.
Right. And being accredited often gives you access to certain types of private investment deals or funds that aren't open to the general public.
But, and this seemed important, the sources clarified, you don't strictly need that label to be an angel investor, right? Especially if you're investing directly in a startup, you know.
Correct. If you have the funds and the willingness, you can make a direct angel investment without necessarily needing the official SEC accreditation. The accreditation is more about accessing certain regulated offerings or funds.
Good clarification. And what kinds of ideas get funded? Is it still all tech?
Tech has definitely been dominant historically. Software, fintech, hardware. But the picture's broadening. The data from 2021 actually showed health and life sciences getting a huge chunk, nearly a third of reported angel investments.
Wow, catching up to tech.
Yeah, even slightly overtaken in some reports. But really, ultimately, any type of business could potentially attract angel funding if it has a convincing plan, a strong team, and real market potential.
This deep dive has definitely pulled out some fascinating stuff about how this world operates. But, you might be listening and thinking, okay, interesting, but I'm not investing in startups tomorrow, so what's in it for me?
And that is the crucial connection. Because the mindset, the principles these successful angels use, they're incredibly valuable, no matter what you do or how much capital you have.
You mean like cultivating that visionary mindset yourself?
Exactly. Start trying to look ahead in your own world. What trends do you see? What future needs aren't being met? What problems could be solved, not just in business, but in your job, your industry, even your local community?
And thinking of your career almost like your personal startup.
Yeah, that's a great way to put it. Invest in yourself continuously. Learn new skills. Build your network. Find mentors. Your team includes the people who support you and challenge you.
And the risk part, how does that apply?
Embrace calculated risks. Not crazy gambles, but smart, informed steps outside your comfort zone. Maybe it's taking on a tough project at work, pitching a new idea, learning a new skill that feels daunting, or even starting a small side hustle. Those are your early-stage bets on yourself.
And focusing on creating value, not just collecting a paycheck.
Absolutely. Shift your thinking. How can you create disproportionate value for your company, your clients, your customers? That drive to create real, tangible value is what angels are fundamentally looking for.
Building your network, too. Surrounding yourself with smart, curious people.
Just like an angel cultivates their network of founders, experts, and other investors. You want people around you who push your thinking.
And finally, that big one, patience.
Oh, yeah. Practice that angel-level patience. Realize that significant growth, financial, professional, personal year, it rarely happens quickly. Those 5 to 10-year horizons for angel investments. It's a powerful reminder that big payoffs usually require serious long-term commitment.
So wrapping this up, what have we really learned? Angel investors are crucial. They provide that vital early spark for innovation.
They operate with this unique visionary mindset, betting heavily on the team's ability to execute and disrupt, often more than the initial idea itself.
They handle enormous risk, not by dodging it, but through smart portfolio construction, hunting for those rare exponential winners.
And they play the long game, needing incredible patience.
But the core idea is having vision, taking calculated risks, investing in people, starting with yourself, focusing on value, building networks, and being patient. These aren't just for investors.
Not at all. They're powerful tools you can use to approach opportunities and challenges in pretty much any part of your life.
So as we finish this deep dive, here's that provocative thought from the material we wanted to leave you with. Just look around you today. What's one emerging trend, one unsolved problem you notice that maybe, just maybe, could be the seed of the next big opportunity for you, for your work, or your community? Try looking at it through that angel investor's visionary lens.